Welcome to our video on Cash Balance 101. My name is Ken Guidrose, and I work as Director of New Plan Design for Kravit'z. Before we get into some details on cash balance plans, I'd like to give you a little background on Kravit'z. We have worked in the qualified plan field for many years. We have 1,200 plans currently, and many of them cash balance plans. In 1997, a client of ours, a law firm, was maximizing their 401k plan, and they came to us and said, can we do more? And so that helped us, or led us really, to design the very first cash balance plan we did for them. And those partners were then able to make six-figure contributions into the 401k plan and the cash balance plan. They were delighted. Since then, we've designed hundreds of such plans. And we found that even though it's 10 years, actually 11 years later, doctors, attorneys, and business owners, they keep asking us the same question. Can I do more? Can I gain additional tax deferral? And the answer continues to be yes. You can layer on a cash balance plan on top of the plan that you currently have. Well, what is it about the 401k limit that's so inadequate? Right here in this slide, we have the 401k amount of $15,500 that can be contributed. Additionally, a profit-sharing contribution of $30,500 for a total of $46,000. But for some, this is not enough. Why might that be? Well, it varies person to person, but maybe they just don't need the income currently. Maybe they've neglected their personal savings in favor of pouring the profits back into the company. That's a very common story that I hear. Maybe their high earnings years started much later due to medical school or law school or some postgraduate education. Some people are just tax averse and they're looking for any way to save on taxes. Whatever the reason, many high-wage earners today feel the need to squeeze 20 years of retirement savings into 10 or maybe even 5. Cash balance may be just the ticket for them. We have here the amounts that can be contributed into the cash balance plan. You'll notice that they are age-weighted. The older you get, the more can be put into the plan. And there's also a lifetime limit for each individual of approximately $2.5 million. Let's put these numbers together. If the plans are combined, a 50-year-old can contribute $51,000 in a 401k profit sharing plan. And by the way, this includes the $5,000 catch-up provision for those 50 and over. And an additional $119,000 can be contributed in the cash balance plan, for a total one-year contribution of $170,000. Now, for many successful people, this is a very attractive contribution and tax deduction. In fact, it results in a current year tax savings of $68,000. And it's not uncommon to see these taxes deferred on these monies for an additional 15 or 20 years or even more. Let's back up for a moment and talk about exactly what is a cash balance plan. They are ERISA-governed, tax-qualified plans. They enjoy a current year tax deduction, ongoing tax deferral, and creditor protection for all the money that's put in the plan. Secondly, they're referred to as hybrid defined benefit plans. Why hybrid? Well, they look a lot like a 401k plan, but at their core, they are defined benefit plans. The question always comes up, how long have these plans been around? And really the question behind the question is, are these plans legitimate, or is this some fringe tax strategy? Well, looking at the history of the plan helps us address this issue. There are 4 key dates or periods of time that give us some good perspective. Bank of America was the first one to adopt one in 1985. Then through the 90s and 2000s, many companies like IBM and others were converting from the traditional defined benefit plan to cash balance plans. In 1999, we received our first favorable letter from the service on new cash balance plans. Then a very important date in 2006, August of 2006, the Pension Protection Act was passed by the government, which added additional clarity to cash balance plans, as well as many safe harbors. Well, how does the cash balance plan work? Let's compare it to something we all know and are very familiar with, the 401k plan. The 401k plan is a function of the contribution plus earnings, and those are driven really by individual investment selections. The cash balance plan, on the other hand, is a contribution, But very importantly, it is a guaranteed interest credit as opposed to just dependent on individual selection. This is a key difference from 401k plans. Now, the rate of return on plan assets will usually not equal the guaranteed interest rate exactly. Well, what effect does this have on the actual rate of return on plan contributions? Well, if an investment earnings are in excess of the interest credit, then the next year's contribution is slightly reduced. If, however, the earnings are less than the guaranteed rate, then future contributions will be slightly greater. Any makeup can be spread over 7 years to dampen any impact on cash flows. Well, what kind of investments are suitable for a plan of this nature? Well, in a nutshell, investments that achieve the guaranteed rate while minimizing volatility. Neither the IRS nor the DOL dictate the actual investment vehicles, but rather this decision is left up to the discretion of the plan sponsor. The plan does require that monies be pooled and invested collectively, and given the target rate of around 5%, the investments tend to be conservative and less volatile. In partnership with Payden and Regal, Kravit'z has launched the new Cash Balance Mutual Fund, which is the only one of its kind specifically designed to meet the needs of cash balance plan sponsors. You can access more information on that fund and other investment dynamics on our website. Well, having designed hundreds of these plans, we've found that the best way to learn about the plan is to look at an illustration. So let's do that and see some of the key features of the plan. What we see here is a common example. It could be a law firm, a medical group, or a successful business. We have 4 shareholders of various ages. Most companies we work with already have a 401k plan, so we're adding it to that existing plan. And here we see that the cash balance maximum contribution amounts are age-weighted. And you can see that every partner may not have the maximum amount contributed for them, so we give them a range of 0 to the maximum number. For example, shareholder 4 may have 0 contributed for him, shareholder 3 may have $25,000 contributed for her, and on. Finally, we see that the contribution due to the employees is a range of typically between 5 and 7.5% of pay. The final contribution actually depends on many factors, including how close the partners get to their age-weighted maximum. I find that the key variable as these plans are discussed with plan sponsors is the balance between what can be contributed for them as the owners of the company versus what is going to be required for employees. Some questions come up very commonly, and that is, what happens to a partner's account if they resign or they retire? Those monies can be rolled to an IRA and they can continue enjoying creditor protection. A second question that often comes up is, what if we have associates in our firm or highly paid salespeople for whom a 5 or 7% of pay contribution is going to be cost prohibitive? Well, those associates can often be excluded from the plan and either just excluded or put into their own 401k plan. And then a third question that often comes up is, what if economics change? What if the cash flows in the company change? There are options. 401k profit sharing contributions can be decreased. The plan can be amended. And there are a number of other things that can be done to mitigate that problem. There are a whole host of other questions that you may have, really, that can be handled on an individual basis beyond the scope of this video. I do want to suggest that you go to our website. It's got a number of resources and materials that can help you. We have a section with case studies on it, a section on plan investments, a section on helping you determine whether you're a good candidate for a plan of this nature. I want you to feel free to contact me directly and explore more specifically your firm, your demographics, and specifically what you would like to do in your firm to see if a cash balance plan is appropriate for you. Feel free to call me, email me at these numbers, and we can talk about that. Thank you.